Good day, this is the third in a four-part series on leveraging and capital structures and trying to determine the ideal capital structure or the optimal capital structure. This section deals with Miller and Modigliani's approach. So where do they fit in? It is part of the theories that are discussed. The traditional approach, the Miller and Modigliani approach, and then also earnings before interest and tax, etc. Okay. What is the Miller and Modigliani approach? They published their initial research in 1958, and the principle was that the value of a firm is independent of its capital structure, and it is only determined by the investment decisions and how the assets in a business is being used. They made some very strong assumptions initially, which said that there are no corporate taxes and a few others, and we'll go into the detail. Those assumptions were then challenged. They then brought out a second paper in 1963, which then released some or relieved some of those assumptions, and they then tried to explain, as we will now see, the structure, the optimal structure, and what the combination of debt to equity should be. Okay, so Miller and Modigliani's assumptions. This is a more detailed list than what you have available, but the important parts are that they refer to a perfect competitive capital market where full information is available. There are no transactions costs, no agency costs. There are no bankruptcy costs in their model, or assumption is made that there are no bankruptcy costs. There are no transaction costs, as we said. The investors formulate similar expectations about the future earnings, so they've simplified it very much in terms of their assumptions. Further assumptions are that the firm's investment schedule and cash flows are assumed to be constant and perpetual. Homogeneous risk classes. There are percent distribution of earnings to the shareholders is constant, and also that there are no corporate taxes, but this they later released and acknowledged that in fact does exist. So what was their hypothesis? And they had the two propositions. The first one was initially with the strong assumptions, and the second one then with releasing some of these assumptions. So in the first proposition, they said, for a firm in the same risk class, the market value is independent of the debt to equity mix, and it is solely dependent on how optimal the assets are being used to generate income. So the value of a leveraged firm is exactly the same as a unleveraged firm, and the reason for this is it is determined by the operating income of the business divided by the firm's cost of capital, and they assume that the cost of capital is constant and does not have an impact, and we will see exactly how they got to that. So the investment in any kind of firm therefore gives the same result, and what matters is the earnings generated with the assets. So they said two companies with the same levels of assets generate the same level of income, and therefore doesn't matter how they funded that business, it is purely determined by the income generated by the specific level of assets. So on a graphical scale, what we can see here is that the change in expected return by the shareholders, KE, that's a required rate of the equity, is exactly offset by the additional benefits of debt, which is cheaper as we use more debt as a portion of our capital structure, and they exactly offset each other so that the weighted average cost of capital stays exactly the same. It doesn't matter what the combination of debt to equity is, because the debt and equity offsets each other in the process. So therefore the value of the company doesn't matter what the level of gearing is, stays exactly the same, and it is determined by the level of the assets and not the capital structure. This led to an argument around an arbitrage, and that was one of the strong arguments that said if two companies in an industry has the same assets and they've got different incomes, then there will be an arbitrage between the two companies. In other words, investors will then leave the company or disinvest from a company who's less efficient in generating income from their assets, and they will return, or they will invest in the company who is more optimal in making returns with their assets. And therefore the argument is that the capital structure doesn't make a difference. The investments will be drawn by the return on the assets in a business. There was some criticism on the M&M model, and it was specifically because of the very strong assumptions that were made in terms of non-substitutability of the personal and corporate leveraging, the transaction costs, the institutional restrictions that were placed, the existence of corporate tax that does exist instead of their assumption that it does not exist. They therefore brought out the proposition 2, which then released some of these, or relaxed some of these assumptions. So what they did is they first relaxed the assumption of no taxes, and let's discuss this, the relaxing of these assumptions, at the hand of a graph. So the first assumption that they relaxed was the one of no taxes. So when you bring taxes into the picture, that means there would be a present value calculation around the tax shield, because we're now bringing in taxes, so there would be a tax shield, and that will add value as we make use of more debt. The tax shield will increase the value. You can see the upward curve of the value of the firm because of the additional tax shield that comes through. So the dotted line is the horizontal dotted line is the value of the unlevered firm. So we start off with the unlevered firm on the left hand side, but as we then introduce the tax shield benefits, the value of the levered company then increases as more debt is taken on. The second assumption that was then relaxed was the assumption of no bankruptcy costs, and the risk of bankruptcy cost will rise as the company's leverage increases. So therefore on the right hand side you'll see there's a present value of bankruptcy cost, and that is a deduction of the value of the company. So the top line is the value of the company, so we need to deduct and penalize, let's call it penalize the value of the company by imposing the additional bankruptcy costs, and that pushes the value of the company down as we incur more and more debt as a portion of our capital structure. The next relaxation is the assumption of no agency costs, and that deals with specifically the imposition of restrictive covenants, and those things could be something like minimum levels of liquidity, and that restricts the performance of the company again, because cash should be available in the companies. They should be retaining liquidity, and they cannot use this liquidity to optimize their returns. There's also a relaxation in terms of, or a realization that the tax benefits will be exhausted or could be exhausted at some point. In other words, at some point the earnings before interest and tax will not be sufficient to so that the full benefit of a tax shield can be obtained. In other words, if the earnings before interest and tax is zero, you cannot have a tax shield because the earnings are zero, and therefore that will also impact the value of the firm negatively. So we then see that the value of the leveraged firm initially starts or increases, and it becomes a peak at the optimal debt ratio, more or less in the middle of this graph, indicated by the little dotted line there. And then as the debt levels increase, there will be additional costs and risks that is incurred, and therefore the value of the firm will decrease as the additional risks come through. When combining the traditional method at the bottom now with the M&M module at the top, it is then clear that we see there is a range of area that is actually the optimal capital structure. So it's not a specific point, and in reality any business does not operate in a static point. They are in a dynamic environment, which means that there would be a range where the weighted average cost of capital is in a minimum range, and that will then contribute to a maximum value range of the company, and that is what you see on the slide there. So that brings us to the end of the third part, and we will then in the last session of the 4-part series look at the pecking order theory, the earnings before interest and tax, earnings per share approach, as well as choosing the optimal capital structure.